Welcome everybody, it's the Market Sniper. Yep, and first of all, Merry Christmas to all of you. Hope you enjoyed it, time with the family, and preparing you for a Happy New Year wish from the Market Sniper team here at your favorite YouTube channel, which you've remembered to like and subscribe so many times. Although you're finding that you're getting unsubscribed, so you're going and hitting the bell notify always so that they cannot stop you from getting the wisdoms. Anyway, glad to be with you. The rates. Boy, oh boy. So one of the things about what we've been saying on our channel, there's a couple of things that we continue to repeat on, and it's the debt, stupid, is one of them. They'll never let you have your own money. Various other key things that we always say, and we have said the point will come, many times we've said this on our YouTube channels, that the Fed's movement or declared interest rates movement will no longer be material, and that the market will start pricing the debt devaluation in its own way. And I wanted to just highlight, just for those of you that say, well, I'm not sure, I don't remember you saying that. A couple of places, you know, while we were working to Peter Grandich, for example, over here, we went into a lot of detail on that. That video is still up. I've actually found the exact place where we reference it when we were talking to small caps of Australia. Let's play that nice and loud. Is contracting, the debt markets are actually slipping. Until recently, even though the Fed was cutting, the rates continued going up on the 10-year. It's now turned and it's coming a little bit down. But that just reminds you, at the end of the day, the central bankers don't really set the interest rates. When things have gone too far, the market sets them and says, we don't like it at that value. We want a higher yield and we want to pay less. So that's how it happens. Capital value down, rates up. Then people start saying, and if you're going to keep printing them at that rate, in actual fact, I'm going to want to pay much less, and I'm going to want a much bigger yield. Okay, reference there. Also, when we were doing our two baldies doing the deserts with Tom a while ago from Palisades Radio, this is probably one of the older ones I could find just with a quick scan. We reference it here as well. So check in with our discussion there.
Peeking it out. What happens is these choices get taken out of your hand. And if you have a systemic collapse in confidence in the debt markets, it automatically goes with an interest rate spike. So if no one starts buying debt on any meaningful level, lots of pension funds are essentially bankrupt and aren't prepared to purchase anymore and are now looking at other asset classes that might have some preservational value to try and put in. And the governments is of various different nations, don't forget this isn't just about America, are all in various degrees trying to support their debt markets. What you end up with is interest rate spike by force of market, not by central banker trend. So no one will be there.
Interest rate spikes on the force of market price discovery mechanism, now that everybody realizes it's no longer a reserve asset. You see, you had a 40-year period where the rates had been pushed so high by Volcker, he bought a very long runway for an asset class where it could, while still underperforming immensely the equity market, it could still make capital gains and give somewhat of a yield. The yield got ever less, ever less. So that part got really tapered super low. Don't forget we hit 0.39 on the CV19 events, which is why we said the most fundamental call that we've ever made was our first and only call in the bond markets, calling the top, which was the short on the TLT trade on a head and shoulders that hadn't yet even formed yet. We took it first on an inverted HVF. We've covered that a lot of times. But the only reason we keep repeating it is its significance, the end of debt as a serious reserve asset. And the powers that be have known that this was coming for an extended period, hence why they've started creating alternative reserve assets, which is why you see a politician like Trump saying he's going to form a US state-based reserve asset fund that will be buyers of Bitcoin and quite potentially other tokens too, such as XRP and maybe Ethereum and ADA and all the other status captured ones that are all part of the ISO 20022, which are the good guys that supposedly are complying when actually they're all going to be part of your digital prison setup. Anyway, we don't want to diverge too much from this. What's clearly happened, and by the way, when we made the call August 2020, It's taken 3.5 years before the likes of Druckenmiller, Paul Tudor Jones, and Zero Hedge began running articles. Has the debt market turned? In fact, we're now calling the debt market turned, etc., etc. 3 years. So they panic. It takes them a while to realize. They reposition their book. By the time they start talking about it, they've repositioned. So remember, people always talk through their pockets. Everyone, including me, we talk through our pockets. We want to see certain things happen once we've already positioned for them. And by the time it's becoming news or even YouTube material, it's quite likely that people have already positioned accordingly, if they really believe that. And what's happened is you now got big hedges, money managers, home offices that have positioned against debt. So quite clearly, Paul Tudor Jones said it as much: long Bitcoin, long gold, long commodities. That's his play. I would say inside the commodities, you've got to be a little bit more careful, because we're going to be touching on oil in a minute. And energies, which I would stay away from a little bit longer. But you've certainly seen in terms of other commodities, cocoa and coffee and those kind of agris absolutely running, which we handled, by the way, in our newsletter. You get our newsletter when you click the link for the free mini course below, automatically once a month, a newsletter from us with key charts. And we covered that a little bit. We showed you that BTC was selling off on a bit of a head and shoulders after being a bit overextended. There was the S&P on a small fractal of the inverted HVF selling off a little bit. It was a little bit of a wobble. And even ahead of schedule, the US 10-year, let's make that a bit bigger, was breaking out. We expected maybe the possibility of a deeper dip, at least to the splitter, and there could have even been, in the most extreme case, a dip down here, which would have been positioned for fear, seeing a bit money coming into the debt markets. But what in fact has happened, and I'm going to take you back out of that and go straight to a core chart, is, as shown by Zero Hedge now, that since the Fed began cutting, that was September, they have now cut 100 basis points, a half and 2 quarters. That is 100 basis points. The US 10-year has gone up 100 basis points. So let's get this straight. The guy setting the price for money is saying, hey, have a full % off, and is doing that over the course of 4 months, cutting it by a full percentage point, and the borrowing, the US 10-year, which is one of the benchmark for the longer term debt, is actually going up in yield, down in value. Remember also on our newsletters, which we've shown before, the seesaws with the currency and the debt. The currency and the debt. Interest rates going up means the currency value going down, the value of the debt. So we are actually getting a US debt devaluation. Now, people that are very nationalistic are going to cheer about how the dollar is so strong. And it is, call it the milkshake theory, for example. And it is coming, and you are going to get a spike in dollar. But it's more about the collapse in the US debt market. Saying, look how awesome this is, and looking at one half of the equation is a bit like bragging amongst all the other parents what a great athlete your son's going to be after you've just stuffed him with Coke Zero caffeine, had him eat all the cakes at the kids' party, and he's herring around knocking everybody over. It's a schizophrenic energy that has been induced not out of good things, not out of a strong economy, better productivity, being the biggest debt Ponzi. And some people say, but Japan is a little more debt per GDP and all of this. They don't rely on international people to subsidize their Ponzi like the US does, and the cost of interest that they pay is significantly less. So when you look at the cost of interest on debt, the biggest interest paying nation of them all is America, and debt rates are going up when the Federal Reserve is cutting. Key divergence, 100 basis points up on the USDT 10-year and 100 basis points down by the Fed. That should be increasing the value of debt. There's so much demand for our debt. Oh, everybody's happy to accept a lower yield. Actually, no. Price discovery mechanism, the market, we want a higher yield, interest rates going up in spite of what the Fed's done. And what's this actually doing is seeing mortgage rates going higher because it's the market that sets the mortgage rates. So if you're looking for a fixed rate, you'll be getting close to 7% now, some over 7%, depending on, I suppose, point score and various other things in terms of the property market. So the cost of living is going up for the Americans for things like purchasing homes and interest rate paid, regardless of what the Fed has just done. And this is a key shoe to drop that we've been warning. The video that we did there with Tom, and it's not even the first time I referenced it, but I can safely tell you while we were discussing that all together, that was more than a year ago driving, and we've been saying that for an extended period. The market takes away your rights to set rates once you are proliferating too much, and that is a huge key drop. It is a key shoe drop moment that has now occurred in terms of what's going on in the debt markets, and people should understand this. Further to that, I've got another video to play. This is coming from a man, Twitter post QE Infinity. I'm not too sure who this guy is, but this is a key point we've also been making, and it's about the rollover of debt. Many times we have highlighted that Yellen has been shortening the fuse on the dynamite stick and been lighting it as well. What that means is, instead of, when the rates were super low, kicking a lot of debt out when it was 0.39 on the longer term, 30 years and 25 years, when there was all the demand, fear in terms of CV19, stock market crashing, everything crashing, everybody runs into the bond market. Instead of getting a lot of debt truly out, she saved on interest. Remember, long-term debt is always more expensive in a normal market than short-term. She put the money out on shorter term, on 2-year, 3-year, 1-year, 6-month, etc. debt. What that actually means is that debt doesn't go away for a long time and you're just servicing the interest rate. What it means is it comes back and requires rollover a lot sooner. If you have a look at the chart just behind this gent before I let him speak, you will see that 2025 has the better part of 7 trillion of debt to refinance in 2025. Just as bond yields are already marching higher. So even my own expectations on the bond yields, let's go back to the US 10-year, by the way, and get that up. We'll come back to the yield curve inversion in a minute. In fact, I'll say goodbye to the Bitcoin chart and add the US 10-year on its own minus the yield curve, because we're going to come back to that. And of course, the yield curve reversions are all happening. So we've spoken a number of times about this falling wedge and said the long term is you break the red line to the upside. That has been our message. However, it shocked even us by how quickly it just pulled back from this localized high and started reversing. In actual fact, we thought there was space for it to come down to at least the splitter, and if we had a real fear moment, a bit of equity weakness, you could have got bids right down to the 3.5s, 3.6s levels on the 10-year. That would have seen money flowing back. However, that's not what's happening. We broke fast and early. That tells me even I, in my own technical assessment of this, was giving too much leeway for a little bit of a rally in the value of bonds and a coming down in the yield than is actually likely to occur. And what we're actually getting is we're moving, and we've called for the 5% levels to be broken when we break. On the macro time frame, we said the red line breaks to the upside. It's ended up happening a whole bunch quicker. It happened this year. We're still in 2024. This is something I thought would be Q1, Q2, maybe even the beginning part of H2, June, July of next year, after a little bit of easing back on account of consumers being a bit wrecked and bent credit cards, and you've got bankruptcies at new highs, you've got commercial property in an absolute mess, unless it's ultimate extreme high end. You've got all forms of credit card delinquencies. You've got a super highly valued stock market, and there's a reason why the stock market is super high valued. People don't want to hold the debt, and they live in a binary world where it's bonds or debt. That's why Bitcoin is being accelerated as a new digital reserve. They want everyone to become speculators in the new digital assets Ponzi racket that they're running, and the on-ramp for the later CBDCs. So that's it. Gold will start to get recognized again, and it's the central bankers that have done it. Too many of the retail guys are being seduced into chasing Nvidia near the highs, chasing Bitcoin and crypto. Not enough repositioning. As the 60-40 became, in actual point, people spoke about it. It used to be 20% in gold, sometimes 10, sometimes at minimum 5. But there was always a gold slice. That just got eliminated. That was the 40-year period of the financialization of everything, where they immortalized the 60-40 portfolio that took out the insurance against central banker malfeasance, which is exactly where you need to be. You need to be over-insured now. You could be 40% gold, and there's no rule. Everybody goes, oh, no, you don't want to say too much of that. 5%, 10%. Listen, you want to be positioned for the times you are in. You need to be positioned for times where you are in. And subject to risk profile, you could be heavily overweight precious metals and gold. Not currently performing. But anyway, but having had a great year, by the way, still $2,622, smashed through the 2K this year. We had a beautiful setup that we traded with leverage on that a while back. So let's go back to that tweet where this gentleman explains in his own words. Now you're starting to hear other people saying what we've been telling you. The rollover duration is getting shorter. You're going to hit a wall. That's the gift of Granny Yoda Yellen and the Democrats, the dementia kid, the one who has a... Yeah, anyway, let's not say what I want to say there. Let's just listen to what this gent has to say about Trump versus the Treasury and what's happening here and the rollover.
America's going to default. America's going to default on its treasury debt. Millennials are going to default on their student loans. People are going to start defaulting on their credit card debt. We're going into debt deflation. Look at this graph. This is literally borderline treason. This is not the yield curve, but a curve of all the U.S. treasuries that have been issued. And a third of them, more than a third of them, are going to come due in Trump's next administration. Look at this, Linda. Jay Powell and Janet Yellen have loaded the entire corporation up on their line of credit. Look at this graph. We couldn't issue 10 and 20 and 15 and 25 and 30-year bonds for the last 4 years. We've paid for the fucking war in Ukraine, the destruction of Gaza, the fake housing thing where we brought interest rates back down, and as soon as they did that, interest rates went up. Because look at this graph, people. This is the scariest graph in all of fucking finance. And you're not going to see it anywhere else. By the way, shout out to Process for...
So he's just highlighting that the front end in his own way, and some of those that expenditure malfeasance that's all been put on your credit card, by the way, that's going to dilute your dollars and crush you. Yes, those pallets of cash being given to gangsters in Ukraine. That's right, with all the circulation and the bungs that are going to politicians for sending the money, why we must give more war, because when they steal public money, they get paid privately for intermediating that gets passed. And that's all the corruption. You are funding the military-industrial complex, the political corruption of huge amounts of bungs and cash that have been ill-gotten gains. That's right. And he's highlighting, and that chart is highlighting, the massive lump that you are going to face that need rollovering on top of all the new supply. Remember that government expenditure is your future inflation. And they are spending more than they get in tax take. The last time I had a percent for that is they are your 52% of the tax take is the portion of the total expenditure. So they're spending nearly twice more. By the way, the interest rate debt, don't forget who that's being paid to. You are paying that interest rate to a cartel of people that were given for free the privilege as shareholders of the Federal Reserve to borrow your money into existence when the government could have done it itself for free for its own citizens. Now you are paying these shareholders of the Federal Reserve, which goes to JP Morgan, which goes back to BlackRock, Vanguard, and all of them that are the shareholders of JP Morgan, that goes all the way to trusts all over the world held by the legacy families. So the exorbitant privilege of giving trillionairedom to people for saying, yeah, you be the guys that borrow, do the money. and borrow it into existence and get paid for it. You're paying that, in short, the interest terms, and it's getting more. So let's go, while we're on the interest aspect of everything, let's also make a turn by the yield curve. So here's the thing with yield curves. People seem to battle with their English on this one. It's inverted, that means it went negative, and it reverts back positive. It's a reversion to positive. People go un-inversion, and they get themselves a little bit of confused with this. It's quite simple. It's a yield curve inversion, and after it's inverted, it reverts back to where it is normally being held, and that is positive. So upside HVF, we had this technical draw. We've been calling for an extended period, and we've had this draw for a long time. There's a W bottom in there with in fact, you've got shoulders as well. We'll sketch it for you just quickly. There on your neckline is a left shoulder. There is a kind of W bottom for you, and there on your right shoulder is the upside HVF that we've seen and called and said you're going to break back above zero. You've broken back above zero. You came back and revisited zero. I mean, this is classic technical analysis on any form of chart. It holds in all forms. You've had the falling wedge return move. There you go. And you've absolutely been bounced back off the key zero line, and you are now buggering to the upside. And can I say that the target for that is through 0.75 differential between short and long term. So what's actually happening, as I pull this down a little bit so that you can see that target, you're at 0.75, just about on the target. That is going to run, in our opinion, on balance of probabilities to and through and potentially beyond 0.75, which means the difference in the long-term debt rates required is going to be far higher than the short-term debt, and you're going to have a steepening of the yield curve. So having had one of the longest reversions negative, having had one of the longest, deepest reversion negative. So let's just say that again and remind people of the overall chart. Your debt system is your fiat system. Collapse in debt will lead to collapse in buying power in currency after the debt finds its floor. So they take turns like left and right to collapse. We are looking at the debt collapse, and the dollar will actually be relative to other fiats, and for a short while even against gold, and risk off. Everybody will sell everything that isn't nailed down. For a while, you will have the dollar schizo spike, which is not a healthy event to be applauded. USA by the likes of the milkshake boys. It's going to be a spike, not a holding point, which will be maintained, because post the debt collapse, as you've shrunk the debt ball, money is borrowed into existence inherently and is a T account. Once you've melted down the one half, the other half comes down substantially as well. The buying power of the fiat when you have debt collapse, also subsequent to the debt collapses. They don't do it at the same time. It's like an alternating. You don't walk your left foot forward at the same time as your right, otherwise you'd be bunny hopping. So it's stage for stage that. So having a blow off relative to other fiats in a schizo spike is not winning. It's part and parcel of a stage collapse of your own debt system, which you'll see people no longer fund your level of expenditures that you have had as an exorbitant privilege. And what that then means is you can only spend at government level as much as you're getting in with only minor borrowings, instead of doing 2x what you've been getting in. That suddenly means you're, as services, going to get a lot less. The American highways are going to be a lot less well kept. Rubber carcasses from blown tires will be left all over the place. It's already happening when I was there in Florida. Your road maintenance, you are going to see a decline, your infrastructure in a lot of things. It's not something to be applauded in that for what will turn out a New York minute, you're going to have a super spike in your currency. This is contagion and collapse. This is not a point of nationalistic pride. And that's my issue with the dollar milkshake guys. When you talk about a dollar surge on a schizo interest rate based spike, you are actually bragging of your debt collapsing more and harder than anybody else. And the resultant move in the interest rates is for short term, seeing people take the higher yield that is being offered on the dollar, that sees more money run into the dollar, that sees the dollar get bid up at the expense of other fiats. But it doesn't stay that way. That's hot money. It's hot money that chases the yield and then leaves just as fast as it came. So back to these inversions, you can see that but for the before the 80s, since the modern era, if we take from the 1980s, mid-late 80s to today, which is the better part of the 40-year bull market in bonds, you haven't. There were deeper inversions before, by the way, but they were much less electronic markets. They were more legacy markets, but you did get similar depth and slightly more. This, in terms of all forms of yield curve inversions, is the deepest and longest of the modern era. And the reversion is now accelerating super fast. Let's just show you that on a monthly basis. Having come and kissed the zero line after that little falling wedge that I drew for you on the lower time frames, you are absolutely ripping, and you're about 40% on your way to making that 0.75 in the first month that you've had the pullback and rejection are at the 0% mark. So this is moving up, and it's during the steepening of the yield curve, that's the movement up of longer debt, that the crisis comes. It's during the steepening of the debt markets that the crisis comes. In short, you are put on notice that things are not under control. Jay's cut 100 basis points, and the 10-year over the same period has gone up 100 basis points. That's a 200 points swing in differential of what the man was doing and what the market did. Now, many people will make excuses for the Fed, and they'll say, well, he was talking hawkishly and saying, that's probably it, and all of that, and word and sandwich and all of that stuff. Listen. From September, you've gone up 100 basis points in an environment where someone was delivering cuts. That simply hasn't happened before in the modern era. It simply hasn't happened before. In other words, it's quite serious. And it is part and parcel of a debt-based collapse. So what do you do? What do you do? Well, those of you that haven't already got your properties financed on long-term loans, should certainly get your fixed rates, because it's going to get a lot more. People will be flushed out of their assets. Ideally, pay off your debt. The cost of holding it is going to get a lot more. Get debt-free. Reduce your living standards. Increase your income as best you can. Have a side hustle. Work harder. Get promoted. Do all those. It's very easy to say. It's not easy to do. Pay off the debt. We've been saying the same thing. People should be debt-free. They own you. The banks own you. And they don't care that these rates will spike and be lack of affordability. It's your business to pay. And then this is going to cause a knock-on effect of loss of value in housing, deflation on the housing side. That's going to see housing coming down immensely, because the ability for new people to buy at the new higher rates and get new loan finance is going to be substantially reduced. So you're going to have an overhang of people trying to hold their price and are not getting buyers. And you get a stalemate in the market. And then you get a forced seller who loses a job, who has to get out, who needs to pay something else off. And when you look at credit card delinquencies and many other things, these things are going down. Can I show you a few more charts of great interest that comes out of all of this? So let's have a look at something that's been going along a lot on Twitter. This guy, elongated muskiness, has been talking a lot and dropping the bankruptcy bomb. Now, he's seeded his dark state operative, as far as I'm concerned. If you were part of the PayPal mafia and you're big mates with Palantir and all of these guys, Peter Thiel, etc., this is controlled frontman for Rockefeller, Rothschild money. And he's dropping the bankruptcy bomb now all the time, regularly on Twitter. At the same time as wanting, low-income immigrants to come in to do his tech stuff. Legal immigrants, he does say, but maybe having people that are paying more tax than they're taking out of the welfare state might be more useful. So this is the early seeding in your brain. Every major event that is due to come, people in mainstream seed it in your brain before to prepare you. It's part of conditioning. And many people have been saying in the fringe media that the US is bankrupt and they will face their bankruptcy day, but they've been fringe lies. Now you've got your big hero who's actually going to be engaged in the Department of Government Efficiency, doggy. And is going to be doing all of these cuts for you in the new Trump presidency, and is actually talking about bankruptcy. This is when you know they are already quite prepared. Let's show you some curves. When are they going to flatten this curve? US national debt. So that's the general debt. That's not what has to be rolled. That's how much you borrowed into existence, 36 trillion and counting, going ever faster. It's in a state of absolute parabola, it has to be said. And just to break that down, that's about 6.4 billion daily. Again, when you think of a billion, you almost think that's a small number nowadays. No, it is not. 1 million, to count up to 1 million would take you an extended period. If you got one number out for every second, it would take you 12 and a half days to do. So that's an unbelievable amount of time to count up to 1 million. To count up to 1 billion, you're going to have to count up for the better part of 32 years. 32 years of saying a number every day to get up to 1 billion. This is 6.4 times that in a single day. You would take 32 years to count one of those 6.4 billion. And that is every single day going on it. And a large amount is going also on interest rate payments. So the debt is the issue. Here's another key point, and one of the reasons why we say watch the energies. Everybody will go, it's because inflation, interest rates are going up. No, let's be clear. Debt collapse. It's about the debt, stupid. Remember, people will say, oh, but that's just inflation. It's that naughty thing where everybody's being mean and putting up their prices first. We know about that. That's how they tell you what inflation is. If you understand inflation for what it is, the extreme proliferation of debt and fiat, because you borrow money into existence, then the answer is yes, it is inflation. It's a debt-based collapse. But the key point for many people is oil is usually a driver of inflation. Oil is in everything, all the delivery, all the packaging, all the plastics, fantastics, everything that's going on, oil is in it. And here's a very useful and interesting chart that I want to show you that many people aren't familiar or even appreciating. Oil versus rates. What you will actually see here is that oil typically is part and parcel of the rates discussion. You have had a major rates climb now on the US 10 years yield on oil doing nothing. In fact, we've been bearishly based on oil, and we've seen why. And they need this thing not to blow up. So my suspicion is they are keeping supply very high. India is selling Russian oil, we all suspect, to the UK with a nice big turn. It's a great business to be in because sanctions, you see. So you, the British citizen, are being taxed for the war that they are waging. They're not stopping Russian oil from getting to you. They're just stopping the Russians from getting all the profits, and some of the profits are going to India at your expense, Mr. UK citizen. That's right. Your government started a war so that you can buy things with 3 intermediaries in between where before there was only one, and thereby pay a whole bunch more, and thereby they levy 80% plus tax on oil. So that's why it's so expensive to drive your car. But there you go. That's what governments do. They are essentially working against their citizenry to impoverish you. That is the game. And the debt rug pull that is coming. And I can tell you, it's without oil even having moved. Imagine now, oil did go up to say $120 or $100 from its current 68, 69s on the WTI. Imagine that. So for all those that will say it's the typical inflation, the thing people misunderstand to be inflation, oil prices, consumer goods, etc., people putting up prices too much, wrong understanding of inflation. It's the extreme debt proliferation and currency introduction. That's the true meaning of inflation. People think of this. It's not the oil. It is not the oil. You are seeing people demanding a higher yield and a lack of interest in buying bonds. And that's why you have a hypervalued stock market at the moment. Okay, so that was an interesting chart. In fact, let's finish with all of these. I think that was the last one. Oh, by the way, so just a wee word on the housing market in the US. So everybody, the US always more strong than everybody else. Always so strong. Love my American customers, by the way. I'm delighted that you're happy and you're patriotic and love your country. You get sold a lot of BS and a lot of propaganda gets put forward on your behalf that I understand that you don't personally believe, but you're not strong. You're not strong. The housing market, single family housing homes, has hit the lowest. I mean, you're talking lower than 2008, 9, and 10, and 11. So essentially, from 7, 8, 9, 10, you've not been lower till 95. I mean, literally, you had a housing-based mega crisis in the US. That was a very American affair, by the way. It did lead to globalization because of the debt that was bought by German banks, Swiss banks, etc., who all bought the Ponzi-nomics of it, and therefore spread the virus, if we may. But this is unbelievable. You have had 2 years now where you are actually lower than the 2008 levels of existing home sales. The lack of this demand for existing homes come as house prices have jumped over 50%. Good luck hanging on to those price gains, especially once the job cuts come. And don't forget, with all this AI talk, the first thing they're wanting to do is to take the labor element out of the cost of business. They want robots that'll work forever with low maintenance and don't need coffee breaks. That's who they are. And that doesn't mean a particularly good job working environment for the average American. So let's have a look at what's going on in other things. We, in our Substack, we also said, okay, what's going to happen? A lot of triggering events have occurred. The US 10-year triggered to the upside. Now we're building further on that. It's gone further up. We also said TLT will be breaking further down. That's that chart. So that is just the inversion in some ways because it's long-term debt valuation versus the yield. So if we go and have a look, we had the US 10-year somewhere over here. If we have a look at TLT, how is it doing? With the 10 years going up and up and up on yield, well, as you can see, it's fallen out of that rising wedges and making new lows. It's taken out a localized low, and in due course, in our view, will take out the ultimate low since the extreme high and will make further new lows. This ETF is a short. 100% short. It is the valuation of debt and it is going down, and it is the reason why you are getting escalating interest rates. Debt-based collapse. Big rollover to come, another 7 trillion, debt-based collapse. It's the debt stupid. I'm going to keep on saying it till you understand it. If people use that inflation word, again, I remind you, it's the excessive creation of fiat through new debt instruments and borrowing money into existence. That is your true inflation rate. So we got the TLT going down. We had the US 10-year going up. In rates. What else was in this newsletter that you'll get? We showed you the inversion. It's moved further up. That is still part of the debt criteria. That was a triggering event and escalating. We've covered that already. And then we said to you, a trade that we've been tracking for a decade, that's almost 30 years long. It came out of the Asian crises of 94, 95, 96 on the Korean won, has triggered. And we are long the dollar against the Korean won. It is the time to be long the dollar against certain currencies. They're not killing it against everyone, but the Western nations of Australia and Canada are going to lose ground, definitely. And we've seen the yen appreciate after the travails of August, where we had the yen curve yield have its issues. But this is the pick of the bunch. Not easy to find for those who have IG available. They offer a USD Korean won. I have no affiliate link. Go and open and market it. In the US, you'll have to find someone else. I don't think they do business in the US, but you may get it in your interactive brokers or various others. So go and have a look at it. But this is a halvening call on this particular currency. We have said It's breaking at 144. The traditional entry is 145.8. We were in it before as it was taking out the tops of this link. So we've been getting in early and we see it running through 2.8. The target is 2.750. But let me just be clear. This thing spikes like a beast and goes virtually no bid when it does of all the currencies. It spikes like an absolute monster. The target for this was somewhere over here, and that is how much excess overperformance you got. So there is real scope for overperformance. Plus, what we're telling you is a doubler. The dollar will buy twice as many won. That's 100% FX call on a major nation. We're talking Samsung products, Hyundai, Kia. We're not talking Guinea-Bissau here or Sierra Leone. This is the nation of South Korea. So I think there will be Korea-specific weakness. They did an ill-advised rate cut. We addressed that in the newsletter. You can watch and have a read there. This is your best and biggest, but you'll also do well shorting the Aussie, longing the Canadian. They're less good setups, but they will still point to loss of value. I will show you for a quick view of those particular currency moves. So we're going back to the US dollar against the Canadian. We have a lot of Canadians in our community that are all trying to escape everything that is being going down on them over there. We have big double bottom calls. We've got a 1.59 over here. We have a 1.656. So that's a fair deval in the Canadian. So it's dollar to the loonie. It's known as the loonie, the pair. We have the USD JPY we've mentioned that's taken back a large amount now of the yen trade collapse. I want to also show you the Australian dollar over here. We have because it's the Aussie to the USD, we have a huge inverted setup. This is a big loser. For those that can't get the Korean won, this is a pretty good alternative. Not as good, and the pattern isn't as beautiful, but it's pretty decent. You should have been shorted already at about 66, but it's now triggered on the main selling point down to 45. So that's well below half a dollar. So that represents quite some fall for Australia in terms of that. That could also see yields going higher. Remember, Australia missed out on the GFC to a large degree because of the China boom. Now there'll be no boom to save them. They've had a double bull on their property markets. There could be a real concern with interest rate spikes as their debt no longer gets valued. Buyers will simply not get there. In short, people will lose jobs. They'll become forced sellers and the market will come down. Potential for a real estate bust in Australia as a whole. What else did we show you? Korean won, the yield, and the other key triggering event that we covered in the newsletter that was further down was this particular chart, the breaking of the gold silver ratio. So what does that do? Well, it shows distress and a bit of risk off. What's actually happening is silver should begin outperforming gold at some point. That's not going to happen. We put the red line here. This is the one we expected to be broken. After this failure, where it only spiked below 75, couldn't hold it and came all the way back in, we said the cycle is extending, and you'll probably find gold will be indifferent. If we're getting a super spike in the dollar, you will see gold actually go down in dollar terms and silver even more so. That's going to be useful for securing supply for the likes of Elon, the military industrial complex, the solar panel guys and everybody else. They should grab all they can get of silver. So in short, we predict that the gold silver ratio is going to extend higher. And that is bad medium term, short medium term for gold. So remember, we're talking about dollar strength here. Real dollar surge that's going to see a double against the Korean won, take real bites into the Australian dollar as a result of the debt-based collapse. So in that period, it's going to be a tough call for everything that challenges the dollar. Dollar long, that's where dollar milkshake is right and accurate. There will be upside in the dollar for a while. It's not going to be sustained forever though, and it should be treated more as a schizophrenic spike than real strength. because it's debt-based collapse that is driving it. It's interest rates, leading the interest rate hike as a result of your debt devaluing most. So this is a bad period with the precious metals guys are going to have to go into one of those long doldrums, patience moments of buying on the cheap in collapses. So keep your cash, that which you have spare, accumulate it, and buy on the dips. There will be plenty dips made available, I expect, particularly on silver. So these were key breaks that occurred that we covered in the newsletter. A 30-year setup that is huge on the Korean won. A major breakout on the gold and silver ratio in the wrong way, all supporting dollar strength. All supporting dollar strength. This is a bull call on the dollar, make no mistake. All supporting dollar strength in the dollar, absolutely. And you go through the debt aspects of it, it's going to be driven by a spike in rates. This is going to be hurting everyone who has borrowed money. Please, now more than ever, get the bankers out of your life if you can. Okay, I hope you found this interesting. There is a real escalation in the debt situation. The key chart is 100 basis points movement in an opposite direction. First time in history when a central banker has delivered 100 basis points in cuts and the core benchmark for the debt has devalued and required an extra 100 basis points in yield. In short, the Fed is saying, value our debt, it's worth more, it's worth more. We're reducing the yield, and the market for it is saying, we ain't buying, pay me more. Two totally different, polar opposite narratives, and it's a first time in history. You heard us tell you about this moment coming, the day the markets set the interest rates, and you will get an interest rate spike. We spoke of an interest rate spike theory, which will be the real driver of the dollar strength. And as I said, it's a sugar rush, it's schizophrenic, and it'll last not forever, but it's going to be exceedingly destructive. Okay, till next time, don't forget, book a call, grab the link below. Hope that's been interesting. You have an amazing New Year celebration. Be on alert for risk off positioning as you go in, particularly as President Trump takes his inauguration on board. He may be set for some very interesting times. Key levels run, they may do what they typically do, bring financial crises on the center-right politician early in his presidency. In fact, they've been taping it together to keep the Democrats afloat. There's landmines planted everywhere. Bye for now.
Tired of profit wipeouts and blown accounts from following trade signal groups and other YouTube channels? Looking for a better way to trade, reduce your stress, and minimize your risk? Become a skilled technical analyst and see the charts and markets in a new light using the successfully proven HVF method by Francis Hunt, while being surrounded and supported by a principled, structured, and experienced community. Enjoy a constructive learning environment while practically trading markets, supported by a bespoke platform run through browser and app, specifically designed to teach and engage you whilst learning and growing as the markets move. This is not a Telegram or Slack signal group. All trade ideas are based on a proprietary technical analysis process honed over decades, which is the HVF method, leading to trade ideas with fast-moving breakouts and tight stops, exact entries and exits, nuanced interim considerations, and ultimately, strong rewards. Submissions are graded and scored by Francis for potential high-quality setups, and we provide bespoke tools to help get the job done properly and with precision. Over time and with focused effort, you'll begin to look at charts and price action just like Francis. Community updates every day by Francis and our 3 webinars a week provide a 360-degree approach, which are presented by our experienced team of trade leaders to spot potential trades. We're a community of self-actualized individuals, spanning the globe and active 24/7, 365. The premium community provides a warm, supportive, and cooperative place for people willing to listen, participate, contribute, and to learn. We've changed thousands of traders' lives. Transform your approach to trading now. Transform your life. Book an introductory call with us on the link below.